Is your business ready for life after you? Here's how to set your business up to thrive for years to come. Business succession is the act of passing the business on from one owner to the next, often but not necessarily without a purchase. When we think of succession planning, we often think about a business being handed off from one generation to another. Mom is handing off the business to her son, grandfather's handing it off to his granddaughter, something of that nature. There's a concept in business succession called shirt sleeves to shirt sleeves. And what this means is that the data is overwhelming that in most cases, when businesses are transferred from generation to generation, by the time the third generation is ready to pass it on to the fourth, 90% or more of the wealth in the business is gone. And the main reason that wealth is gone is because A, there wasn't proper succession planning put in place, and B, because the family constitution was not put in place that provided for proper guidance and restrictions of how the wealth of the business would be used, as well as the disposition of the business itself. Putting in a succession plan, which is something that we help our clients do, you can be one of those families like the Mercks or the Rothschilds that have enjoyed the perpetuation of the wealth that their family generated for centuries. We help ensure that your situation will be the exception. And rather than going from shirt sleeves to shirt sleeves where the value of the business has been dissipated in 3 generations, you can be one of those families like the Mercks or the Rothschilds that have enjoyed the perpetuation of the wealth that their family generated for centuries. You may find it useful to set up what's called a family constitution. When families plan for the intergenerational transfer of wealth, they often find it useful and comforting to make sure that there is a document that sets forth the values of the family, the values of the business, and the guiding principles by which key decisions about the business and the wealth that it represents and will generate in the future will be governed. Such a document will often outlive the founder of the business, and that document serves as a guidepost to make sure that the family keeps you in mind as the founder of the business, to make sure that the family is doing things that you would like to have done with your wealth and what you've built, even after you're gone. So for example, one way that I've helped a family with this, I helped a billionaire family in South Asia write a constitution. They had built their wealth in the textile industry, and they wanted to make sure that the client wanted to make sure that his sons and his grandchildren would use that as a platform to build wealth for generations to come. Many business successions don't take place involving direct family members at all. I can tell you my own experience, many times a son-in-law or daughter-in-law winds up inheriting the business into which they married. In other cases, there's an employee who's been a loyal and effective employee for maybe decades, and the owner wants to give that employee a shot to take over the company and build their own fortune. Business succession requires a good deal of planning in order to be successful. It'd be a shame for you to build a business over the course of years or even decades, hand it off to somebody with the best of intentions, and find out a few years later that was run into the ground. The first question you ought to ask is, why do you want to have a business succession plan in the first place? Many people prefer to sell their businesses, and of course that is the most obvious exit. But it doesn't necessarily work for everybody. You may decide that you've earned enough money and you want to give somebody else a chance to run the business. You may feel that the business itself is a core asset of the family and you'd rather that it stay in the family rather than turn liquid, because when a business is turned into money, then frankly, money is easier for other family members to do dumb things with, spend unwisely, and the Vanderbilts spend the entire fortune and not have anything left for future generations. Maybe you just have a sense of altruism. You want to make sure that your employees are taken care of. You want to make sure your clients are taken care of, your customers, even your vendors are taken care of. And the best way to do that is to ensure the stability of the business. There's no wrong reason for deciding that you want to have a succession plan for your business rather than an exit plan. But it is important to understand why it is that you're doing it, because the answer to why you're pursuing a succession may govern or may influence your other decisions about how you're going to pursue that succession down the road. The next question to answer is who? Who is going to be the recipient of the business? Maybe it's somebody that you've already identified. If you've had exceptional foresight, You may have identified a family member almost from birth that you've targeted to succeed you in the business. And there are families that do that. The Mars family, who own M&Ms as well as many other brands, are renowned for having a family-wide indoctrination program, basically from cradle to grave, to make sure that every child in that family is prepared to play a key role in the business. However, if you're like most families, you probably were more concerned about running the business, growing the business, and making sure that it's thrived and survived, rather than focusing on succession right out of the gate. And so you may only recently have identified specifically who it is that would be the logical successor to the business, or maybe you don't even know yet, but you can still think about who in terms of a general profile of who would be the ideal successor. Would you prefer it to be a family member? Would you like it to be an employee? Would you like it to be maybe a good friend, a trusted advisor to the family, somebody that isn't necessarily related? Again, there's no wrong answer. Once you decide the why and the who, it's now time to decide the how. You may decide that you want to simply gift the business to a future generation or to whoever the recipient is, in which case you're going to need to get together with your accountant and your lawyer and probably somebody like me, a business appraiser, to determine the value of the business that you are gifting, because there are often tax implications for doing so. And it is your obligation as a giftor to make sure that the tax is correctly computed and paid. It is, generally speaking, not the recipient's obligation. Now, you may decide that rather than have it be an outright gift, you may decide that you want to transfer shares or ownership of the company over time. You may decide that you want to do it through a trust, because there are ways of exercising governance and control over the disposition of the business even after you formally relinquish the reins. There are also significant tax implications, at least for American businesses, in the succession planning process. And how you structure that transfer and the vehicles by which you effectuate that transfer can have significant implications for your tax liability. Finally, you may decide that you're going to transfer the business to somebody that you designate, but you'd like them to pay for it. Maybe you're not going to make them pay full price, but you're going to give them a significantly discounted price. And that's a perfectly rational or reasonable position to take. Even if you're making somebody pay for the business, you're still potentially doing them a favor, because first, you're giving them the opportunity to buy the business outside of a bidding process, which likely means that they're going to be paying much less for the business than they would if they had to buy it at an open auction. Second, you may invite somebody to buy the business on very beneficial terms. So, for example, you may allow somebody to buy the business, but do so by letting them pay you over a 10 or 15-year period with a nominal interest rate, which is going to be a better deal than they're likely going to get on the open market. So they're still going to have to work for it. They're going to have to make the business successful, but you are giving them a much better shot than they would get with an arm's length transaction. You may just decide that you want to outright discount the business, but you feel like it's important either for yourself financially, or you feel that it's important ideologically for the successor to pay something for the business to ensure that they're invested in it. Even in these cases, there's a good chance you're going to need a valuation, because the IRS is going to want documentation and independent verification that when you sold the business, you did so on a fair market value basis. And if you decided to sell the business at a discount, then that the differential between the fair market value of the business and the actual transaction price may also be a taxable event on you as the donor. Finally, you have to decide your timetable. When do you want to trigger this entire process? Now, like many things in life, the longer runway that you have, the longer advance notice that you have, the more likely your preparation is to be successful. So if you're just thinking today that I think I want to keep the business in the family, or I want to make sure that people are taken care of with the business, and that's not going to happen if I sell it, you may want to take some time, perhaps years, to effectuate the planning necessary so that you achieve the outcome that you want. And it's worth doing, because you've invested a lot of your blood, sweat, and tears. You've sacrificed a lot in your life. You've put a lot of capital at risk in order to build this business. And so it would be a shame to go through all that effort, understand all that risk, enjoy all that success, all of a sudden to have it fail in the last mile. So set forth a timetable for when you want this all to take place. And if you've identified the people that you would like to take over the business, then get them involved early. Get your advisors involved early. It's not too early to get your accountants thinking about what the process is going to be. It's not too early to get your legal counsel to give you advice in terms of what the best structure is going to be. It's a great idea to have a valuation of the business done 2 days, the starting point of where the business is from a valuation perspective, so you can manage that value over time. And also understanding the value of the business today. Also, understanding the value of the business today can help you optimize a transfer in order to minimize your tax exposure. In addition to the valuation work, high score strategies can also help you with putting the succession plan and family constitution in place from a mechanical perspective. We'll work with your lawyers and your financial advisors and your accountants to put together what will effectively be a business plan that is aimed towards succession. Thanks for watching this installment of Your Business Value. And if you received value from this video, please consider liking and subscribing, and let me know in the comments what topics you would like me to cover next.